Hey everyone, welcome back to Ujaxanti. In this series, we try to understand whether the current rally of Bitcoin, which started in early 2023, resembles more with 2019 rally, which we call a bear market rally, or resembles more with the parabolic rally that we experienced in 2020 and 2021. In the first part of the series, we had a look at the breakout of gold of its multi-year resistance zone. It happened in 2019 and it similarly happened in 2024. In the second part of this video, we discussed the correlation between Bitcoin dominance and the price of Bitcoin in USD terms. And in the third part today, we are going to speak about the yield curve, specifically the inversion of yield curve. And the links to part 1 and part 2 can be found in the description of this video. Please check out those. And let's start with the yield curve. Just a very short introduction for those people that are not familiar with what a yield curve is. We have yield curves for bonds, specifically US government bonds. And in today's video, we are going to discuss bonds of the United States only. Now, let's start with the normal yield curve. On horizontal axis, we have term to maturity of a bond. And on vertical axis, we have yield of a bond. This chart may seem a little bit complicated, but it's a very simple and logical chart. It basically suggests that if the term to maturity of a bond is longer, then the yield is or should be higher. In a practical example, if you lend your money to the US government for 10 years rather than 3 months, you are going to get compensated with a higher annualized yield than someone else who lent the money for 3 months. Because 10 years, because you are going to get your money back in 10 years, not 3 months. So you take on more risk and you'll get your money back in 10 years, not 3 months. That's why you are going to get compensated with higher yield. However, sometimes illogical things happen in the bond market. And now let's start with the inverted yield curve. As we can see, it's called inverted because the chart is not normal. It's the inverted chart of the normal yield curve. In this case, we have again term to maturity on horizontal axis and yield of a bond on vertical axis. And this chart suggests that the longer the term to maturity of a bond, the less the yield will get. It basically means that if you lend your money to the US government for 10 years, you are going to get lower yield than someone else who lent their money for 3 months. Yield curve inverts rarely, but whenever it happens, it's a signal for the overall economy. And it's evident that this is not logical. If you lend your money to the US government for 10 years, you shouldn't get less yield than someone else who lent their money for 3 months. This indicates, the inverted yield curve indicates that the economy is not healthy. And it indicates that the bond market is not efficient. And here we have the yield curve in the United States as of June 2021. As you can see, this is a normal yield curve because the longer the bond maturity, the higher the yield. However, there are some rare instances, for example now, that the yield curve is not normal and it is inverted. This is the Treasury yield curve in the US as of June 2024. As you can see from this chart, right now, 2-month or 3-month bonds have much higher annualized yield than, let's say, 10-year bonds. And this should not be the case. This is not normal. So that's why we call this an inverted yield curve. By the way, we differentiate 2 types of rates, short rates and long rates. Short rates are those for bonds that mature in a couple of months, let's say 1 month, up until to 6 months. And then we have long rates, which usually is 10-year, 20 or 30-year bonds. And the short rates can be directly controlled by the Federal Reserve, which is the central bank of the US. However, the long rates cannot be directly controlled by the Fed. This is because when the Fed increases its Fed's fund rates, which is the official interest rate of the US, the left-hand side of this chart goes up with it. Right now, we have Fed's funds rate sitting at 5.5%, and that's why you see very similar percentages here. So the bonds that mature in a couple of months, 1 month or 2 or 3, 4, 6 months, they have very close yield to the short rate. However, that's not the case for bonds that mature in 10, 20 years. This is because the right-hand side of this curve cannot be directly controlled by Fed. However, they can indirectly control this by selling or buying bonds from the commercial banks. That is a tool in the central banking, which is called open market operations, but it's not in the scope of this video. The only insight, the TLDR, is that the Fed can control fully the short rates and it can control the left-hand side of this curve, and it cannot directly control the right-hand side of this curve. And the yield curve got inverted because the Federal Reserve increased its Fed's fund rate and short rates got increased simultaneously with that. That's the logic of the inversion. And another thing is that the US Treasury doesn't issue all these types of bonds equally. Usually, they issue 3-month, 2 years, and 10-year bonds. Those are the most common bonds of the US Treasury for the last couple of decades. And that's why we just take the yields, the annualized yields of these 3 bonds, 3-month, 2-year, and 10-year, and we compare the yields with each other. And we don't look at the yield curve because this chart changes every day, and it's easier to compare 2 or 3 bonds together rather than have a look at this chart, which has more than 10 data points. And this chart changes every day. And for that implication, we compare the yields of 10-year Treasury with 3-month Treasury bonds. In this chart, we subtract the yield of 3-month bond from the yield of 10-year bond. Logically, in most of the years, we should have positive numbers in this chart, which suggests that 10-year bonds have higher yields than 3-month bonds. However, as you can see, there are some rare instances when the 3-month bond provides higher yield than the 10-year bond. And this is what inversion is all about. And the shaded areas are the US recessions. And as you can see, for all the recent recessions that we had, before that we had an inversion of yield curve, specifically 10-year and 3-month yield curve. We had 4 recessions in this chart, and for all 4 cases, the yield curve of 10-year and 3-month got inverted before the recession. It was a signal. It's a leading indicator that signals that the economy is not healthy, the bond market is not efficient, and a recession may come. And in these 4 instances, recession came. And we have another chart which compares the yields of 10-year and 2-year bonds. This is very similar to the chart that we just saw. It just, instead of 3 months, we used 2 years. These two are the most used charts for yield curves. We just look at it. And again, the story is very similar. We had recessions in these shaded areas. And before recessions, the yield curve got inverted. So 2-year bonds provided with higher annualized yields than 10-year bonds. which again indicated that the economy of the US is not healthy and the bond market is not efficient. And we can have the same chart in trading view. Here we have the yields of 10-year bond minus the yield of 3-month bond. And we can see that there are some rare instances when this number goes negative, indicating that 3-month bonds have higher annualized yield than 10-year bonds. Right now, starting from 2022, we went negative, so the yield curve is inverted. And we see that just before the COVID pandemic, this was inverted. Then this is before the great financial crisis of 2007, 2008. This is before the dot-com crash. And it can be seen that before the recessions, before the US recessions that we had, this indicator signaled a recession. However, we can note that this indicator is not perfect. In 1966, it got inverted, indicating that there is a looming recession. However, it didn't arrive until 1970. But before 1970, we had another inversion. It can be argued for that this one was a fake signal. And there are some other instances when it almost got inverted, but it didn't fully. If we go to the weekly chart, there is a high chance that some of these instances were inverted. Let's just have a look. No, this one, for example, got just inverted a little bit. So it just crossed the negative part of this chart. And what about these ones? No, these ones didn't get inverted. Let's go back to monthly so that we can see the big picture. So we can state that this indicator is a robust indicator for predicting recessions because its accuracy is almost perfect. And whenever the number gets close to zero, it may not go to negative side. However, even going close to zero indicates that the US economy is not strong and the bond market is not efficient, and there are some cracks opening up in the economy, indicating that there is a high chance of recession that will follow up. And right now we have one of the deepest inversions of 10-year and 3-month bonds. And the story is similar when we compare the yields of 10-year and 2 years. So both of those charts show that both of those are inverted. Both of those charts suggest that there is a high probability that recession will follow. And coming back to the Bitcoin story, we started with the question whether we are in 2019 or 2020 type rally right now. In 2019, we had an inversion of yield curve. As can be seen here, this was it. This was the part. This shaded area is the COVID recession, short-lived recession that we had for a couple of weeks. And this is back in 2019. So even before the pandemic started, even before all of us knew what COVID is, there was a sign signaling that there is a recession coming. And also, this signaled that the US economy is not as strong as it should be, and there are some cracks opening up. It's difficult to say whether we would have a recession if there was no COVID. However, this indicator was correct once again. And coming back to Bitcoin, the comparison that I wanted to make is that in 2019, we had the 10-year and 3-month yield curve inverted, and it's the same story in 2024. Of course, it got inverted in 2022, however, it's still inverted. And as we saw in the charts, usually recessions come when the yield curve gets reinverted. So it's not the inversion, it's the reinversion that matters for recessions. That's why we can state that from that perspective, from the perspective of yield curve, again, this rally can be compared to 2019 rally. And the inversion of the yield curve may very well be the reason that Bitcoin dominance increased in 2019. Let me show what I mean. Here we have Bitcoin dominance chart. Let's put it in logarithmic. In the orange line, we have BTC's dominance. As you can see, this is something that we discussed in the second part. In 2019, we had a rally. BTC rallied against USD. And that was the case for BTC dominance as well. Bitcoin's dominance rallied as well. Then here we have Bitcoin rally started, the rally that started in early 2023, the rally that we are currently in. And the story is similar to 2019. Bitcoin dominance increased by big margin. And that's not the same in 2020 and 2021 because Bitcoin dominance plummeted during that rally. And this may very well be the reason that in 2019, BTC rallied and BTC dominance went up. And the same can be said for 2024. But the same cannot be said for 2020 and 2021 rally. This is simply because when there is a yield curve inversion, investors tend to take their capital into the safe assets. And if you are in crypto, Bitcoin is the safest asset. So investors see that the yield curve is inverted. That is a signal that there is a high chance of recession coming up. So investors want to avoid losses. If they want to continue to have an exposure to some financial market, in this case it's crypto market, they will just eliminate their risky assets and they'll take their capital into the safest ones, into BTC. That's why in 2019, yield curve inverted, investors wanted to take their money into the safest asset, BTC. Bitcoin dominance rallied. Exactly the same happened in the last 2 years, the rally that we are currently in. However, the exact opposite happened in 2021 rally. We just experienced a recession back then. We had quantitative easing going on. Excess liquidity was abundant in the markets. And we saw that investors wanted to take on more risk. They bought more altcoins than Bitcoin. And that can be stated with this chart. Bitcoin dominance plummeted. It means that, there was a demand for Bitcoin, high demand for Bitcoin. However, altcoins experienced even higher demand. That's why BTC dominance went down like this. In sum, then, we discussed the ideas related to Bitcoin dominance in the second video of this series. However, we didn't go into details of yield curve, and in today's video, I just wanted to shed light on it because I believe that is the primary reason, the inversion of the yield curve was the primary reason that we had this correlation between Bitcoin dominance and Bitcoin's price back in 2019 and recently in 2023, 2024. I hope you found this interesting and informative. Please like and subscribe, and I'll see you next time.